This program is designed for those that need to develop a business case to justify the investment in a new systems and business process improvement project. By the end of this module, you will be able to describe the techniques for building the business case for a proposed investment, apply those techniques to quantify the business benefits and the costs, determine the return on investment achievable with the project, describe the factors you will need to consider when building a business case. The simplest way to start this type of analysis is with the existing profit and loss statement. Every business has one, and they all follow a fairly common format. An example is shown here. If you are not familiar with this document, you may want to study the financial module in our Understanding Retail curriculum for a detailed explanation. In addition to the P&L, this example shows two extra items of data: the average stock carried by the business in the year in question and the net present value, NPV%, to use in calculations. The average stock figure is used to calculate stock turns and is therefore required in any project that involves changing inventory levels. The net present value is a way of discounting revenues and costs that occur or arise in the future back to their worth today. For example, if you have a benefit worth $5 million in 3 years' time, it would be worth $5 million minus 11%, minus 11%, minus 11%, or $3,524,845 today at an 11% discount rate. Depending on how far into the current fiscal year you are, you can use the last complete year or the forecast outturn for this year if it has been trading long enough to be reliable and if you can get access to the data. Let's take a look at the calculations we use to determine some key retail metrics. Take some time now to click on each metric, which is highlighted as you pass your mouse over it, to see the detailed calculation behind it. By selecting the Resources tab in the top right of this window, you have the option to download a document which contains all the calculations from this module. A simple way to start formulating where the benefits of a project will occur is to review each line in the profit and loss statement in turn. Let's start with sales. Will the proposed solution increase sales? Many do, but not all of them. Will the solution reduce the cost of goods sold? Perhaps through smarter buying, sourcing changes, reductions in shrinkage, and so on. Will the solution improve gross margin? Not directly, because gross margin is an outcome or a result, just as profit before tax is an outcome. Gross margin can only be improved by reducing the cost of goods sold or reducing markdowns. Will the solution reduce expenses? Perhaps, but it may also increase them in order to fund the solution itself. Expenses are usually grouped into 12 to 15 major headings in a retailer's accounts, so they will often need to be considered at that level of detail. More on this in a few minutes. EBI, TDA, earnings before interest, tax, and depreciation, is an outcome. Interest can be increased or reduced depending on the impact on inventory levels. Inventory has a financial carrying cost and a physical carrying cost. These numbers vary from retailer to retailer, but are generally about 12 to 15% of the cost value of the average inventory. Reductions in inventory will reduce interest charges by the saving in financial carrying costs. Expenses can be reduced or increased by any changes in the physical carrying cost of inventory. Depreciation will often be increased because of additional depreciation charges on the CapEx extended to acquire and implement the solution. This chart shows part of a balance sheet. When formulating potential benefits, as with the P&L statement, it is helpful to review the balance sheet to identify other potential benefit areas. Will your solution improve cash? There are two main ways to achieve this. One is by reducing receivables, i.e. money you are owed, and the other is by reducing stock. As stock is reduced, its value is turned into cash. In a purely retail business, receivables is mainly money owed to the retailer by the credit and debit card companies. Better payment systems, which result in faster settlement, can reduce receivables, and for a large retailer, a one-day reduction in settlement time can mean a large amount of money. Sometimes it can be the outstanding balances on carpet or furniture sales which have not yet been fulfilled. In a business which includes wholesale, receivables will include trade accounts unless they are shown separately. Some solutions will help reduce receivables by better management of trade accounts. In most cases, fixed assets cannot be reduced except in the longer term. Stores and warehouses are what they are. They can be disposed of when their leases are up, if they are no longer needed, but they can't generally be made smaller, except by leasing surplus capacity or space to a non-competing complementary business. Department stores do this as routine with concessions. With the rise in omni-channel retail, many retailers are finding that growing their online sales reduces the need for brick-and-mortar stores, so some reduction in fixed assets may be possible, depending on circumstances.